with so many managers who just absolutely, utterly refuse to think it through. They won't do it. And the reason is because they've benefited so much before, and it really pisses me off because they're making tens of hundreds of millions of dollars, billions of dollars on the backside of people who are losing their purchasing power every single year, every day, every fucking hour, but they don't care.
How they maintain any credibility in the eyes of the public is what's astonishing to me, right? Those of us who pay attention are like, you guys are just such buffoons. I cannot believe you have the keys to the car, right? You guys actually get to run this country and run the monetary policies. That's just insane. But they do, and there's nothing we can do to stop it. We can at least criticize it, and thankfully now we have a release valve, right? You can go into sound money. You can actually get out of this clown world and get onto a lifeboat called Bitcoin.
What's up, Sats fans? Welcome to Swan Signal. My name's Sam Callahan. I am your host today. If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today. We have an awesome show lined up. We have two individuals with extensive experience in the world of finance, and specifically in the hedge fund space. We have Mr. James Lavish, who is a self-proclaimed reformed hedge fund manager, and now writes the wonderful Informationist newsletter. And then we have Dr. Jeff Ross, a former physician and a hedge fund manager of Vailshire Capital Management. Welcome to the show, guys. It's wonderful to have you on. Did you guys catch the Super Bowl at all yesterday? You guys football fans?
Well, first of all, thank you, Sam, for having us on. I appreciate this. And the answer is I was cooking dinner, actually, while it was on the background, but no sound on. But living in Texas for 20 years, yeah, football is kind of, it runs through your blood. You have to have it on, even if we weren't paying that much attention to it. It was pretty exciting. Yeah. From what I could tell, though, it was pretty exciting. So
for sure.
Yeah, and thanks for having us on, Sam. We went over to some friend's house. That was the one football game per season that I watch, and so we got it. It was a good game, though, admittedly. Other than that final call that the ref made, the holding on that.
I know
that was a pretty lame call, and that kind of ruined, I thought, the end of the game. But is what it is.
I know it could have been a classic, and then this ref came in, and it's ridiculous. Well, let's get into what we're here to talk about. So, I'd like to start by just asking you guys a little bit about the hedge fund business in general. I mean, you guys have both experience in that industry. It's no secret that active fund managers have had a more challenging time over the last decade or so compared to more passive investing strategies. I think a lot of this is due to like central bank interventionism propping up asset prices. They even banned short selling in 2008 to the detriment of some of these active managers. Do you guys think now we're headed into a different time where active managers might start to outperform passive? I'll throw it to Dr. Jeff first, and then James.
Sure. So, let's recap what happened since basically 2009 to 2021, which was basically up only, right? So if you owned any risk assets or if you owned bonds, it was up only for you. It's hard for active managers, especially hedge fund managers who are literally trying to hedge, meaning you have protection against downside losses. It's hard to beat up only if the markets only go up, right? And so if you're shorting, if you're protecting against downside losses in general, it's going to be tough, and it's going to be hard to beat passive investing. I do think that this decade is very different, right? We definitely we don't live in a free market society. These are centrally planned and centrally controlled economies and markets for sure. That's why we all talk about what Powell's going to say and what they do next, because this is not free market economics anymore. This is what happens when you have central planners moving interest rates around, moving liquidity around, contracting it, expanding it, those kind of things. This is, though, where I think because of their past actions, we have a lot of bills to pay this decade, and they're all coming due this decade. And I'm looking forward to talking about this, especially with James here. the bills are coming due, right? And so things got very overvalued by the end of 2021. Stocks were at historically high valuations. Bonds were overvalued. Real estate was overvalued. Private equity was overvalued. It was a crazy time, and so all of those bills are coming due. We've seen a nice retracement throughout 2022 to kind of take some of the steam out of those markets. But I think there's a lot of room to go down further, possibly depending on how things are handled. And so I do think that this is kind of the decade of active management. I don't want to, obviously I'm biased clearly, right? I think active managers can outperform passive management strategies, but this is, I think, going to be a decade kind of similar to how the 1970s were, where you had to think in terms of alternative investments. You had to think in gold, emerging markets, real estate, hard assets, Bitcoin, those kind of things. This decade, I think, are going to be the winners, whereas they've been the losers for the last couple of decades. So I'd love to hear what James has to say.
Yeah, no, that's a great explanation, Jeff, and I fully agree. Like when markets go straight up, I mean, and you're hedged, you're going to take away some of your performance on a relative basis, right? But like Jeff is saying, I completely agree that we're coming into, I think, a little bit of a tumultuous period here. Everybody's keyed in on the Fed; they're expecting them to pivot, and we can talk about that ad nauseum. But
Yeah.
um, I think that we're going to get into a choppy period here where we have the market has a lot of uncertainty in it, and so we will have some periods of bull runs and bull traps, and we'll have some bear traps too. And so I think that the active managers, what's important, and something I want to key in on what Dr. Jeff said. What's really important is the active managers. What they're aiming to do is limit your downside. If they're good active managers, they're trying to hedge out certain risks, isolate that alpha, which is the return you're trying to make. If you see an opportunity, you're trying to zone in on that opportunity and isolate that opportunity and hedge out all of the other risks, whether it's event risk, whether it's market risk, whatever it may be. And so you can, if you're trading currencies, for instance, because of some general macro idea or theme that you're investing in, but you want to hedge out a little bit of that certain interest rate risk that you have with maybe the Fed or something. You can hedge that out while you still play this overlying theme that you're thinking of, right? So that's really important. But what's most important about that, and what for your listeners to understand, is, well, why does that matter? Why does it matter if you limit downside risk? Well, it's just simple math, right? So the cardinal rule in investing, and Dr. Jeff can back me up on this, is don't lose money. And the reason for that is because if you lose, let's use big numbers so people can conceptualize it. But if you lose 50% of your capital one year, you have to be up 100% to make that all back, right? So just think about it. If you have $100,000, you lose half of that, you're now at $50,000. Well, in order to make up that $50,000 you lost, you only have $50,000 left. You have to make 100%, another $50,000 to get back. And that's why it's absolutely essential for investment managers who have this capability to understand how to hedge yourself so you do limit your downside risk. You can never guarantee that you're not going to lose money. I mean, that's just asinine for for managers to say that, because you just don't know what can happen in the markets. That's why they call them black swans. But I do think that we're getting into a period of uncertainty here. I think the markets have gotten ahead of themselves. I hear everybody with the soft landing, now maybe no landing. I saw a Bloomberg article this morning that maybe there's not even going to be a landing. We're just going to kind of take right back off. Yeah, well, if we do that, I can tell you, bar none, the U.S. is fucked, because our inflation will just ramp and we will be in deep trouble in 5 to 7 years, like deep trouble. So I don't think that's going to happen. And why? Because I think the Fed's going to hold it, they're going to tighten the screws. They're going to hold them tight for enough of a period to prevent inflation raging out of control, which it could still happen. If you look back at the 80s, you could see that happen when, what you had two different Fed chairmen, Burns and Volcker, and you could see when they let off the gas or they let off the brakes, the inflation spiked again, and they had problems with that. But the problem with where we are now, and you've heard both of us talk about it quite a bit, is we have too much debt. You can't let inflation run out of control like that. It'll cripple us. So, yeah, I think that the Fed's going to stay on it. And that just means that as they drain the market of liquidity, they pull out liquidity. You look at M2, it's contracting. As they pull out liquidity, it makes the cost of capital more expensive. And if the cost of capital is more expensive, that means that companies are making less money. The margins are squeezed, right? It costs more to get access to capital, to make things. You have, sticky inflation on certain goods and services. So it's difficult, for them to maintain those margins. And if the margins come down, well, their earnings come down. Their earnings come down, then those multiples that you're seeing in the market, they're going to have to come down. So it's reality, and I would love to live in unicorn land with everybody, but I'm not, look, you've got two kind of bears on here, but I'm not a bear. I just think that we have serious uncertainty ahead of us for the next 3 to 6 months. That's how I feel.
Yeah, yeah. No, I thought that was an excellent summary. And that's the worry that the Fed's kind of having a premature victory over inflation, just like the 70s. And I'd like to throw something to Dr. Jeff, but first I'd like to read a little blurb from Seth Klarman, another hedge fund manager, billionaire investor. He recently said, a decade plus of low interest rates had helped erect a financial fantasy land. A consequence-free era of virtually unlimited low-cost capital had come to an end. A boom based on easy money policies will inevitably contain the seeds of its own destruction. The sharp rise in interest rates last year will be kryptonite, saying it has finally helped deflate the everything bubble. So, Dr. Jeff, I mean, that's similar to kind of some of the things that James was alluding to there. And Seth Klarman seems to be, those were pretty strong words from him. Do you have any reactions from his comments?
Well, I think he's right on, right? And this is what we're talking about. At some point, you have to pay the bill. And so we've been kicking the can down. But then what happens is inflation pops up, and that makes it much harder for the Fed to kick the can down the road a little bit more, right? They're kind of trapped right now. And so that's what everybody sees. Anybody who's paying attention sees that you can't just go back to QE infinity right now while inflation is running hot, because then you run some serious structural risks. So I will say, by the way, I want to say, because James said we're both kind of bearish here, I'm actually bullish for now. I like to say, with that little caveat, for now, I'm bullish, and we can get into the whys of that for now. But I think
let's
that.
do it.
Well, should I jump right in and then
I want to hear your bullish take. I would
bullish
love
for
to
now.
see it.
Okay.
Yeah.
Okay. So I am of the opinion that everything changed in October. So basically, what had been happening from Q4 of 2021 into October of 2022 is liquidity was contracting throughout the globe. And in October, it's September 30th to be more exact, everything changed. It bottomed right there, and then since then, the liquidity, at least by the way, I follow things, both global liquidity and even, I would say, sort of stealth QE here in the US has started again. And so you can see the effect of that across all of the major asset classes, at least the ones I care to pay attention to. The dollar peaked at sub 115 right around. So this is all right in that time frame. Don't hold me to September 30th, but so around the time frame of October, the dollar peaked sub 115 and has been coming down. VIX basically peaked the volatility and has been coming down. Bond yields peaked and have been coming down in general. They've been trending lower. Risk assets generally across the board, both in the US and internationally, Chinese markets, European markets, emerging markets in general, all kind of bottomed and they've been in, at least the way I look at things, they've been in a channel of expansion since that time. They've been actually doing quite well. Bitcoin, I think, would have bottomed in October, but thanks to scam, bankster fraud, it pulled it down for like another month or so. And that kind of, I just think it was like it was trying to get up above the water and it pulled it down for another month. And so so Bitcoin was mad. So then it started surging come December, and it's been, obviously, it had a nice run. We're pulling back here a little bit. But so in general, I think the trend currently for now is up, and I'm bullish in general. I think, like, even right now as we speak, it's the 13th of February, so the day before the CPI comes out. To me, it looks like things have in the very short term have gotten a little too bearish. I'm actually more optimistic that when the CPI gets announced, that we may have a surprise to the upside for risk assets. And I hate to make calls like this because all it does is make me look stupid when I'm wrong, and I probably will be wrong. But I think that we may have a bit of a run until that what we're talking about, this recessionary bear market sets in. I definitely think a recession is ahead of us still. I don't believe that we're going to have a no landing or even a soft landing. I think we're probably going to have some kind of a harder landing at some point. But I think risk assets may do well for the coming, I don't know how long, days, weeks, quarters, possibly, maybe a year. I don't know how long, but at some point we have to pay the bill. But in the meantime, the music's playing, so I'm up and dancing.
That's good. I think, I so many of the data points that you mentioned there, Jeff. I agree, but I think that a lot of that is already played out. Now, I don't. Again, this is all probabilities. We play probabilities. I don't talk in certainties, because we don't. There's nothing certain in the markets. But just like Dr. Jeff just said, there's a lot of reason to think that many of these risk assets and the liquidity data points are pointing to a risk on atmosphere. But you're starting to see certain market risks, certain economic risks creep in, and those are like things like Bank of America. I've got my notes over here somewhere. A couple of weeks ago, had just announced, they had talked through their earnings, and they're like, "Hey, look." Maybe it was JP Morgan. I apologize. I can't remember which bank it was. It was one of the major banks, Citigroup, JP Morgan, Bank of
One of the
America.
mega banks.
Yeah. And they said, look, the credit card, the debit spending was only up 1% last year, but credit card spending was up 22%. And credit card, the credit card revolving debt was up 17%. So what you're seeing is there's a few things that are starting to play out. We're watching very, very strong employment numbers, but remember, I think that there are many managers who are shell shocked from being unable to actually hire people back during the pandemic. And I was talking to a guy who's in construction here. He owns a construction company, and he said, "Look, I don't want to let go of any of my employees, because I could barely get them to come back when they got those stimulus checks during the pandemic. They're like, why am I going to go back to work? I'm living for free here. They're going to keep giving us checks until this whole lockdown is over." And so they had a real hard time. He had a really hard time getting and keeping employees. And even though the construction business was doing gangbusters in late 21, early 22. So that's one thing. Is I think that you're seeing companies, and especially services, who are they're reluctant to give up employees. They're afraid it's going to be difficult to hire them back, and it takes a long time to find the right people. And if you've ever been on the hiring side of the desk, it's not that easy to find the right people for the spots that you have. I mean, if you do it the right way. So that's one thing. But you're starting to see companies who don't really they're massive, that don't really have a problem finding talent now in these days, which is the large technology companies. They're just laying off people in the 5s and 10,000s at a pop, and they're taking that spending risk off their table, because they know they can just turn around and get them back. There are a few other industries they can go to, if they're technology people. So you're starting to see that. And I think that what happens here is, as the Fed continues to hold the screws on liquidity, that there are ways that they're allowing some liquidity to leak back into the market, but I think they're doing that just to make sure that the Treasury market remains very stable and very liquid, and that is true. But as you keep that cost of capital high, eventually you'll see some of these watershed moments where you just have a drawdown in either liquidity of certain certain sectors and certain companies, large companies that just have some surprise downsides, and they start laying off people. And that, I think that's the risk, is that you have that watershed moment while you're super long, and you get taken out at the knees, and that's the issue for me, and that's the risk here. And so, do I know it's going to happen? No. I mean, this is a crazy world we're living in, and I do know that the Fed and the Treasury can't let this market fall apart completely, because if they do, the tax receipts will plummet, and then our debt problem only gets worse. So they're walking this super razor thin tightrope over a
Yep.
canyon, and they know it. And so that's what we're all kind of watching. We're like with popcorn, but it's pretty serious. So
Yeah, I feel like it's difficult when it feels like the economy and asset prices are kind of not moving together. Like it reminds me of 2020 when Jim Cramer, there was that image of him where the Dow had its best week since 1938, and then there was that little headline at the bottom that said 16 million Americans just lost their jobs, and everyone was like, "That seems crazy. That's completely distorted." And I feel like right now we're in a similar situation where you have PMIs contracting, you have housing rolling over, you have starting to see cracks in the labor market, but you have asset prices just ripping. And it goes to this like liquidity question of, how much money they printed in the last couple of years. You look at like price to earning ratios and price to sales ratios, and look at the valuations. And Joe Calasari, somebody all of us know, he mentioned like, are those like good metrics to look at anymore, considering these new liquidity conditions? I was wondering if you guys have any thoughts on that. Do fundamentals matter? I guess that's the question.
yeah,
Do
of course they do.
fundamentals
Long term,
matter?
yeah,
Yeah,
yeah, long term they do, but everybody's trying to play that short term pivot, so they're trying to anticipate it, right? And so
gotcha.
what managers don't want to do is they don't want to be caught short if the market rips, if the Fed, if the Fed loosens the screws and backs off rate raises or even pivots, which I don't think they're going to do anytime soon. If they do that, yeah, risk assets will rip. They'll go straight up. So you've got this, we're in a perverse period, Sam. And, Jeff and I have lived through this a number of times where bad news is good news for the market. Bad news for the economy is good news for the market. Why? Because people think that, well, the Fed's they're going to ease. The Fed's going to they're going to ease off the tightening, or they're going to turn and pivot and start printing again. And so it's super perverse to look at the market cheering on unemployment, or cheering on, the layoffs, or the worst PMI numbers. It's just perverse, and that's where Wall Street and Main Street clash in these moments. It's awful, and this is not funny. It's not a game. We're not playing a game here. We're trying to manage our money the best we can, but this is not funny. People are going to, there's a danger that people are going to get caught off sides here, or they're going to have too much leverage. They're hearing, oh, no, the housing market's fine. Go buy that house, or don't worry, buy this car. You can, don't worry about your last loan. And you saw this, that thread, right, Jeff, where somebody who's a dealership owner, right? And I can't, I
I know
again,
what
I
you're talking about.
apologize. I don't remember. Do you remember who this was, Jeff? Uh,
I don't. Do you, Sam?
It
but
was like
anyways,
car dealership. Yeah, I think I know what video. Are you talking
so he
about
was
that
talking about how
video?
it's this new thing where the car dealers, they would uh, refuse somebody a loan if they were too far upside down in their car. Right now, of course, this last month we had blowout car sales, which was just nuts. Um, but so now they're doing this thing where, and this might have added to it. They're doing this thing where they're saying, well, if a person comes in and they bought a car, and say they bought a used car, and they bought it for so much money because the used car prices went straight up, and now the used car prices are kind of they're drifting back lower, actually, pretty quickly. So so they come into the dealership and they're underwater on their car. Well, you know how it works. If you're going to trade in your vehicle, well, then you've got to, if you have credit because your car's worth more than you owe on it, great. Then you get to apply that to your car, which, if you're not over levered, or you didn't buy a car for too much or whatever it is. It didn't depreciate too rapidly. Well, then you've got a positive input there. Well, now there are a lot of people who have they have negative equity in their car, meaning that the car is worth less than they owe on it. So when they go into a dealership to trade it in, they have to pay off that note that they own that they owe on the car, because they trade in the car and they're like, okay, that's great, but the car's only worth, $27,000. You owe $39,000 on it, so
Right.
you have to pay me $12,000. So here's the kicker: the dealerships, apparently he's seeing these other dealerships say, well, just default on that note, just let the car be repossessed. Don't worry about that $12,000 you owe on it, and buy this brand new car that I have for you. And that's what they're doing. So there used to be like this unsaid, unspoken, value or truce between dealerships. They wouldn't do that to each other, but now they're doing it. And so just to get another sale. Anyway, so it's just screwy things like that, like this is just a world that it's just, I think
It's
like that
concerning.
stuff
It's
starts to
concerning.
collapse, right? So
Yeah. It reminds me of a video that went around where it was similar. It was in a car dealership where a guy had a TikTok video and he was asking, hey, what's your car payment? What's your car payment? And some people had two car payments that were like $1,600 a month. And they were like proud of
exactly.
it. That was the concerning part. These people didn't understand like kind of how screwed they were when you talk about that, especially with the assets or the prices of these cars dropping pretty rapidly in the last quarter or so.
Yeah.
Um,
Yeah,
yeah.
exactly.
Dr. Jeff, I don't know if you have anything to add there or we could
Oh
move
man, I
on.
got a lot of comments. First, on the last thing you just said, is all about incentives, right? When you have a financial system and monetary system where you have a constantly debasing currency, and the way the system survives is by credit expansion forever, right? And it expands forever until the value of the currency goes to zero over time. It's just math that it will do that at some point. People will lose confidence in the currency. So how are people incentivized, right? They're incentivized to take out as much debt as possible, to not save money. The government applauds you when you spend money on whatever crap you spend it on, because you're growing the GDP by doing that. So the government incentivizes all this. So that's why when people go around, they're proud of their debt payments that they have on their depreciating car. It's just insanity, right? I mean, we don't have nothing of a savings culture anymore. We have nothing of an investment culture anymore, because that's just completely counterintuitive to our current Keynesian system. So that's just a side note. And then going back to your original question, do valuations matter anymore? To James' point, they always matter over the long run. But I think when you have a centrally influenced economy like we do, I'll say not centrally controlled, because it's, that's too communist, but we're centrally influenced for sure. Um,
Heavily, heavily,
heavily centrally
Heavily
influenced.
influenced.
heavily influenced and manipulated. Yes.
Exactly.
Yeah, there you go.
It does come down to, again, and this is my view and I could be wrong, but monetary expansion again. And when you have multiples, when you have an expansionary monetary policy, so liquidity is expanding, multiples generally expand with that expansion. And when you have a contractionary liquidity regime, you'll see the multiples contract as well. They kind of go hand in hand, and that's how I look at things. I'm a momentum guy, obviously, and a macro guy. So that's kind of how I view the world of risk assets. And so that's why we unfortunately have to pay attention to what these central bankers are doing, even in China, even in Japan, even, around the world, when they're flooding the system with liquidity. Even when things look dark, for me, that kind of trumps everything. Nothing political, not that Trump. So it overrules all of those other factors. Like, I think the economy looks so ugly, and I think it looks like we're going to just go for just a very hard landing. But when you see this liquidity kind of expanding, whether covertly like it is here in the U.S. or overtly like it is in China, that liquidity, I think, has to go somewhere. When institutional investors, commercial banks, and those things have that, and they're not parking that in like the overnight reverse repo rate, right, to get their safe yield, they're moving a little further out on the risk curve. That has an effect, I think, on risk assets, and I think that's what we're seeing right now.
Yeah, that's a good point. I mean, you brought up the debt and brought up the treasury, James. You brought up the treasury too. And you wrote an excellent piece in your newsletter about the debt ceiling. And I think it's kind of top of mind
Mm.
again, kind of every year. Dr. Jeff, actually, you described the debt ceiling as a canopy of clouds in the sky above. They appear to be a ceiling, but in reality, they're just like a smoke cover that you can pass right through. So people are worried that the U.S. is maybe going to default on its obligations. And here comes the talk of the $1 trillion coin. And from my understanding, it's basically like, hey, why don't we just print or mint $1 trillion coin, throw it on the Fed's books, and presto, we can spend whatever we want. Problem solved.
Yeah.
But maybe James, maybe you have a more refined take on that subject. So, is the $1 trillion coin? What do
Well,
you make of it?
See, the thing is with the $1 trillion coin, I think it's ridiculous. But so it's semantics, right? It's all the Congress. All right. When I played hockey, right, we had two teams, and I've used this analogy before, but we have two teams, and we'd literally go out and we would kill each other on the ice. I mean, we'd fight. We would hit each other from behind with our sticks and cross check and we would just like maul each other and hate each other and like in each other's faces and then whoever won after the game, you shake hands, number one, because you're hockey players,
Right.
you shake hands and you go off the ice and you all end up at the same freaking bar, drinking beers together, cheering and salute and hugs. And it was, the bottom line is it's just all a show. We know that we're in the show together. And so that was part of the deal. We're like, we're in a show. We're going to give it the best. We want to win. But, at the end of the day, we're both in the show. We're both actors in the show, and that's what it was. And I'm not belittling the intensity of athletes, because that is real. But at the end of the day, at the end of the game, you're all together. It's the same thing in Congress. I mean, these guys are hugging each other. They're high-fiving in closed chambers. They don't give a shit about any of us at all. They pretend they do, but they don't. We all know that. So this whole thing about the $1 trillion coin is, you've got the Republicans trying to say that they're going to limit spending because they want to protect their constituents, and they're saying that their constituents don't like the easy spending of the Democrats. The Democrats are saying, no, we've got to protect these this class of citizens who are not being spoken for, and whatever it may be. But they're doing this in the chambers, and so but afterwards they don't really care. They're just it's all a big show. So what's the $1 trillion coin? Well, there's this nuance in our law that says that you can't print, like, there are only certain denominations you can print for gold and silver and other other metals, but platinum was kind of left out of that. So you could take a platinum coin. It doesn't have to be the size of this room. It can just be a platinum coin, and you could print it and say, okay, this coin is worth $1 trillion. And you could take that coin, you can, as you said, deposit on the Fed's books. And then the Treasury can then borrow against that, because the Treasury had it minted and they deposited it, and then they get to borrow against it. And so all it does is a stopgap measure between now and when they raise this debt ceiling. So it just allows the Democrats, in this case, could be reversed if we were on the other side of the aisle, but they would just mint it, print it, and then borrow against it. And then when they figure out what that debt ceiling is going to be, then they pay it all back with future debt. So like when they go and issue more debt, then they pay off the coin. They take the coin, they go melt it and put it away. But if they don't come up to an agreement, well, maybe they print another coin. And so it's just a threat that we're just going to keep printing coins until you give us what we want. It's just a joke. And so, and the rest of the world would look at this and say, really? This is what we're doing now. We're printing coins, like fake coins, to manage our debts. Like, this is just ludicrous. It would make us look like absolute clowns and a circus, And so I think it's a joke. I think it's ridiculous. It's humiliating that we're even discussing it. Maybe we ought to discuss our debt problem. Maybe we ought to discuss our spending problem, instead. So that's my take on it. I hear it that it's a stopgap measure, so we don't accidentally trip the ceiling, and which we already have, but we don't miss our obligations because we're not allowed to issue any more debt. But
Yeah. Dr. Jeff, you got something to add?
It's just all nonsense, right? This is what
Yeah.
you see as you get further and further along in this Keynesian experiment that we're in, and as you get closer to the end days, it just turns more and more into a clown world. And things that literally they would have been just absolutely laughed off the stage as you're insane and you're ludicrous for even talking about such an idea 30, 40, 50, 60 years ago. Now we're actually considering. There are actually people who are considering this and are who are promoting it, and that's just
Yeah,
a
two former heads of the mint
yeah,
have talked about it.
Jeez.
They're
it's
like, yeah, we should
insanity.
totally do it. It's insane. Yeah.
Yeah. It's just all
Biggest
trickery,
clowns.
right? Smoke, mirrors, whatever, and how they maintain any credibility in the eyes of the public is what's astonishing to me, right? Those of us who pay attention are like, you guys are just such buffoons. I cannot believe you have the keys to the car, right? You guys actually get to run this country and run the monetary policies. That's just insane. But they do, and there's nothing we can do to stop it. We can at least criticize it, and thankfully now we have a release valve, right? You can go into sound money. You can actually get out of this clown world and get onto a lifeboat called Bitcoin. You can get into gold as well. I think is still sound money, and so, anyways, it's just very frustrating to watch. It's humorous. You have to laugh about it because if you don't laugh, you're gonna cry because it's just so devastatingly stupid.
Yeah. So,
Yeah,
and
let's
then, and going back to your original statement about defaulting, like there are a lot of ways to default. And, if we defaulted on our debt, we're not going to default and just not pay it. It would be, we would raise the ceiling, issue more debt, and pay off the old debt. I mean, that's what we would do. That's what we're going to do. So back in, I think it was 1979, the Congress actually waited too long to pass a new debt ceiling, and the Treasury had not anticipated this taking this long, and they hadn't printed out and enveloped all the checks to be sent out to the bondholders. This is 1979. It wasn't done. It wasn't all done electronically back then, and so they actually missed some payments because they just got them out in the mail too late because it was just so it's a technical default, right? They wound up paying all the interest and more because of that gap that they didn't pay. So they have done it before, and I think it very well could happen again, especially because of how polarized our Congress is, and how the two different parties, they're not working together. Wink, wink. And so they're they could very well trip it again. The problem is though, is this is all just putting a massive spotlight and bullseye on our debt problem that we shouldn't be putting. We should be doing every single fucking possible thing we can do to take the shine off of that. We should be doing things like shooting down balloons over Lake Michigan and calling them aliens to divert everybody's attention over there, because we should not be focused on this. This is the last thing we want the world to be focused on.
yeah,
You know,
yeah. Don't look at our debt, please.
Please don't look at our debt. Like, why are we like? It's asinine for us to be putting ourselves in a spotlight like this. It's just
Yeah,
ludicrous. Yeah, I mean, we've talked about the debt being a problem for a very, very long time. I
right.
mean, this is not new, but it is new that we're sitting here at 120 to, depending on your measure, if you're using local and state debt as well, 135, 136% debt to GDP. Man, for
Yeah,
your listeners, what does that mean? Well, that means we have so much debt that we can't even make the interest payments on the money that the Treasury doesn't make, but they collect from its citizens through taxes. We can't even pay off our interest payments every year. So we have to issue more debt every year to do that. And the debt is just growing.
just keep spending.
It's going to be
Just keep spending.
it's going to go it's going to go exponentially here. Sorry, I think I cut you off, Jeff, but I think that's the point.
Yeah.
So
Well, Jeff, you brought up how hard monies like gold and Bitcoin. You're obviously bullish on that. Maybe this next decade, let's just say. It reminds me, I spoke to a hedge fund manager in 2021, and it was the top of the bull market, and he manages like $1 billion in assets. And I told him, I only focus on Bitcoin. I think it's the only thing that really is real in this industry. And he came back at me and he was just like, "You're the first person to say that, one. And two, all these other cryptos are outperforming Bitcoin right now and they offer yield. Bitcoin doesn't offer yield." And he sent me an email just out of the blue a couple months ago. And he's like, "I get it now. Bitcoin is the real deal." But
It takes a while.
for these,
It takes a while.
for these hedge fund managers, they have to look at, like, they have to always think about outperformance, right? And it seems like you guys both figured it out, right? You guys came to Bitcoin. So how do you guys answer questions around that to, like, say some of your colleagues or maybe even your clients about like Bitcoin, not crypto? And how do you describe this? Because I still think it's a battle that we're fighting, this narrative of how Bitcoin is different from the rest of the cryptocurrency space.
Well, I'll start here, James, and then you
Yeah.
can give the real
Yeah,
answer. But
please.
a couple of ways that I think about it. First of all, I think Bitcoin is just simply better money. I think it's changed the world technology, and I say crypto is more of the same world technology. And
Hmm.
so Bitcoin, which again is very simple, right? It's decentralized, secure, apolitical money, permissionless money. Crypto, what cryptocurrencies are is they're unregistered software companies that have a token that is just an unregistered security. But it's even worse than when we think of securities, registered securities. Like if a software company, were to issue a stock, at least with stock you have equity in the company. The crypto tokens literally give you nothing. You don't have a stake in the company. Actually, some of them give you voting rights. All of that is just pure nonsense to me, right? They're trying to ride the coattails of Bitcoin and pretend to sort of be like Bitcoin when it's convenient and confuse the public. And I think the crypto marketers have done a fantastic job of confusing the public. Jamie Dimon is confused. Warren Buffett and Charlie Munger are confused. They'll never get Bitcoin, by the way. My personal take. Jamie, they're all incentivized not to understand it. Politicians are confused across the board, and unfortunately, that's a bit unfortunate because they make the regulations that go for this. One thing I'm slightly encouraged about is I think Gary Gensler, the chair of the SEC, actually does understand Bitcoin. He talks about it as commodity money, which I think is the best way to think about it. That commodity, by the way, is energy underlying Bitcoin, and crypto, like he talks about. He understands them clearly as, look, you guys, let's be honest. You guys are software companies. You just don't want to admit it, and you don't want to be regulated. And since you're not going to do something about it, we're going to do something about it, and we're going to come after the exchanges and do some choke point things. So that's how I view it, and that's what I tell people. And most people don't get it. And then I'll stop here, and I'd love to hear what James has to say. But anyone who cares about crypto, I would say, with the only possible exception of Ethereum, there's a slightly different mentality with them. But across all other of the crypto world, all people want to do is get rich quickly. That's all they want to do, right? They want, if their project fails, it will make zero difference to the world tomorrow. They're just lottery tickets. They're a way to basically participate in venture capital, but at a hugely accelerated pace. And it's the first time ma and pa investors, retail investors, can invest in venture capital like returns and gains. And so that's why it's just this distorted clown world, obnoxious world that to me, again, it's just more of the fiat system. It's basically bringing the fiat world into this. You take everything that's good about Bitcoin and you suck that out of it, the decentralization and the blockchain technology. You talk about it like it's some major deal, and then you bring in all of this fiat nonsense onto it and you speed it up 10 times to 100 times, and that's what crypto is. And so I think that crypto, I tell people, and I'm sorry, I'm still talking, James. I think that crypto, I'm not convinced it's going to have another run. I think the regulators are actually coming this time around. And so I'm not convinced that the next time Bitcoin goes on its next bull run, as liquidity starts to expand again, and as we get through this business cycle and out of past this recession, I'm not convinced crypto joins it, because crypto, I think, is finally being called to the floor, and so we'll see. We'll see if it makes it out of it. But I think there is massive regulatory risk in crypto right now, and I have a lot of friends who are still doing that stuff, and I'm like, you might make a lot of money again, like you did the last cycle, but you also might get wrecked in your crypto if it gets called out for what it truly is. It's going to zero, and it's definitely going to get flushed out of the United States. So I'll stop there.
Yeah, 100%. And so backing up, I think for the people that I talk to, Sam, and in the institutional investing world, it's crazy because what I often have to do is I have to back them all the way up to the fiat system and understanding money. And here's the crazy thing: you've got some of the smartest money managers in our space, some of the smartest hedge fund managers that then they're either heads of family offices or heads of managing directors of these funds. They're portfolio managers, and they have no clue that inflation is not normal. They don't get it. Like they just don't get it because they're so ingrained. It's like, why not? It works great. We need inflation. No, you don't. Think through it. And they can't. They just can't get there. And the problem is this system has worked so well for them that they don't want to get there. They've benefited so enormously from the fiat inflation, deflationary, system to inflate assets that inflate them. They're not really inflated. They're worth more dollars that are worth less. It's clown world, but it's so difficult for them to critically think about that. And that's the problem, is that you have so many managers who just absolutely utterly refuse to think it through. They won't do it. And the reason is because they've benefited so much before, and it really pisses me off because they're making tens of hundreds of millions of dollars, billions of dollars on the backside of people who are losing their purchasing power every single year, every day, every fucking hour. But they don't care. They just don't care. And so that's number one. The problem is they refuse to think about it. And when they do, and so that's where I start. I go back all the way back to, hey, listen, think through inflation. Just think through it. And then we get to the conversation about Bitcoin and Bitcoin versus crypto, just like Dr. Jeff just laid out, right? And then it always comes down to regulation. And so I do have some confidence that Gary Gensler is pro Bitcoin, especially in contrast to everything else out there. That he's not going to go protect it, but I don't think that he's going to go attack it. Not him. There are other politicians who are going to attack it. Like Elizabeth Warren. Like talk about somebody who's absolutely clueless. Like she's just utterly clueless. She's just grabbing onto one thing that she can say, well, this is what my constituents care about. So I'm going to go grind this into the ground while I go fly around in my private jet everywhere and talk about it. Talk about sick people, right? So, so I do think that we do have a positive there. And once we do get some regulation, that will open the door to the fact that these managers who refuse to learn about it will have no choice but to learn about it. They will have absolutely no choice. Once it's regulated, it's on the platter of assets that they can choose from to make return or to protect capital with. And once it's on that platter, now they're in competition with everybody and saying, okay, well, I better know what this is. And because I need an allocation, I'm going to go get a 1 or 2 or 3% allocation while I figure it out. And that's when they start figuring it out. It's going to take some time, but I do think regulation will help. And I honestly, I saw that clip. Did you see the video clip of Gensler talking about steak versus steak? Did you guys see that? Yeah. I think that was kind of a little bit of a wink, nod, wink to the Bitcoin community. He knows we're all, carnivores, right? So, but honestly, I think I think that once we do get some clarity around that, I think it helps, and that drives it forward. It accelerates it. Let's put it that way. It accelerates it.
Well, there certainly has been a regulatory crackdown over the last month or two. I mean,
has to
specifically, yeah. I mean, the SEC just charged Kraken for offering and selling unregistered securities through its staking as a service program. Gemini and Genesis also sued by the SEC for offering selling unregistered securities. Custodio Bank got their membership declined at the Fed. The Fed, OCC, and FDIC penned a joint letter, warning banks of the risk of crypto assets. So you're just seeing all this coordinated effort recently from the regulators and the government. And so we'll definitely see how it plays out. I want to pivot a little bit here because James, we just had some of your partners, Larry Lepard and Greg Foss, on, and you're the managing director of a new fund, the Bitcoin Opportunity Fund. And that's available to qualified and accredited investors only. But I think it's really interesting what you're doing. So I would like to know, why you started to build it and why you're building the Bitcoin Opportunity Fund now, and just hear your thoughts around that, because I just think it's fascinating.
Yeah, I mean, if you look at where we are in the Bitcoin cycle, right? We're in a trough, and we've got an economic cycle here that I think is going to get painful. And so you've seen a wipeout of the the Bitcoin miners in particular in the Bitcoin mining space, and we're starting to see that this summer, early this fall, we started to see some some companies who had no problem raising money, young companies, start looking around and saying we're going to have to raise money at different valuations now. And they're called down rounds, where you raise money that is it's more dilutive to the early investors, and that's painful for everybody. And if your early investors don't re-up and fund that next round, well, you could come into a liquidity crisis. And we're starting to see some of that around the landscape. So, but backing up, yeah, so my partners are Greg Foss, Larry Lepard, Mark Moss. Larry Lepard's, he's got a partner in his hedge fund unit, David Foley, and he and I are the managing partners of this. And then we partnered with Swan. And so
Mhm.
we've been talking quite a bit with Corey on the fund. So, but the reason that we're doing is because of our experience is understanding how to, like we were talking about before, like Dr. Jeff was talking about before, is isolating that opportunity and managing the risk around it, dampening that volatility. Yeah, you could just go and buy Bitcoin alone, but you'll get a different risk adjusted return if you take advantage of opportunities like this, especially in the distressed area. So we're looking at buying distressed assets, distressed miners, doing vertical integrations with power companies, hedging out certain risks using strategies, hedging out using shorts, put call strategies, whatever we may use in order to limit downside. And limiting that downside is what's important to us, because this is a super volatile ecosystem. And so, but that said, I think that we're right at the beginning of the growth of this system, and it's going to grow exponentially over the next decade. And we'll have another cycle like this, I think, in the next decade. So there will be multiple opportunities to do this. So we're excited. We
Yep.
think that we're seeing a lot of opportunity already, and we think there's going to be more opportunity coming down the pipe. So yeah, it's for accredited investors, and qualified investors only, but there are a lot of those in the Bitcoin space. So, but yeah, we're excited. We're excited
Very cool.
to to start this thing.
Yeah, I mean, it sounds like the perfect time to do it. And when you guys both brought up risk management, and it just seems like that's what actually separates the pros from the amateurs. I mean, you look at all these like crypto hedge funds that just blew up; they had zero risk management, right? But Jeff, I mean, Vailshire is celebrating its ninth year. So congratulations! I saw you tweet that and said, what, they gave you 10% chance to survive 1 year, and now you're celebrating the ninth year. So obviously you're one of the guys that does have risk management, and that's what you guys bring to the table. So um just congratulations, man. I just wanted to give you a shout out on that. That's great.
Hey, thanks, Sam. Yeah, I've had the
Yeah,
ability to make every possible mistake imaginable and learn from them. Like I think one thing I have going for me to go along with my my lack of wisdom and insight, at least I have some humility to learn from my mistakes. And I think James can attest to this. I know Foss talks about this a lot. It's tough managing money for other people, and you quickly like realize like you have a lot of limitations. You thought you saw the risks, but there were other risks that you didn't consider. You maybe hedged, but you didn't hedge enough, right? All of those things are very difficult, and you can only know what you should have done in hindsight. And so I'm thankful. Yeah, I mean, I can't believe I'm still here 9 years later, and I love it. I love it way more today than I did before. A lot of it, by the way, is just the advent of Bitcoin and Bitcoin coming around, and how that's sort of given me a change of focus as well. So like what I love about James and his fund, what those guys are doing, they're going into an aspect of Bitcoin that in traditional finance, there are a ton of people who invest. There, billions and billions of dollars of fund managers who are into the distressed debt sector, who like to make private investments, who do all these kind of things, and also can go across span the public markets as well. There's almost nobody doing that in the Bitcoin space. And so these guys are like, they're trailblazers. They're one of the first groups to be doing this. It's going to go very well from this. I think that they'll be legendary, 10, 20, 30 years from now, because and I'm not saying that just to blow smoke up James' kilt. They're getting into it at a great time, and they have great minds doing that. And so there's a lot of room in the Bitcoin space for fund managers, for smart people. If you know how to take advantage of opportunities, you can make a lot of purchasing power for your clients at this point in time. And I think it's sort of like I like to liken it to, it's sort of like living in Silicon Valley in 1995. Like you just happen to be in the right place at the right time, and if you catch those trends at the right time and you're well positioned for it, they're going to be off the charts, and with their returns, and with the way they can change the world for the better. So I'm super excited
Yeah.
about their fund, and I'm excited for Vailshire as well. I think there's a lot of opportunity ahead.
Yeah. Thank you, Jeff. I mean, yeah, and that's the thing, Jeff, is like, you know, I can't remember. I think it's 80% of funds. You would know this because you and I talked about this long ago. 80% of funds fail because the 80% of the funds that fail are because of just the inability to meet operating costs. And so you were very smart when you set out and did this by staying humble. You didn't hire a big team. You didn't, spend a lot of money saying, "Well, we're going to go," that because that's not the right way to do it. You have to have just you or a couple people who are head down, just do the work and pay the bills, and then get to the next, the next day. And yeah, the funny thing is, Sam, you were talking earlier in this conversation about hedge fund returns, right, and how they've lagged. And here's the crazy thing: is that has a survivorship bias to it, that number. So you're only counting the hedge funds that made it. So the fact that Jeff has made it and his hedge fund's doing well, I mean, that's he survived, and so he's not even being measured against all the ones who didn't. He's only being measured against the best. So that's pretty good, and that's the
Wow.
crazy thing. Yeah.
Yeah, I mean, when I'm if I'm looking for a fund manager, I want ones that are humble and ones that can manage risk. So both of you guys seem to have that. So
Right on, brother.
I like to just end with like one more question. I know you guys have been generous with your time. Let's talk about like tomorrow is going to be a CPI print. Let's talk about inflation a little bit to end this conversation. Maybe what do you guys see? It's been rolling over for 6 consecutive months now. CPI inflation. Jeff, you mentioned that you're kind of thinking maybe there could be actually a surprise to the upside. Maybe where do you guys think inflation is going to go for the next couple of months? But also, James, you said this point. It said people should be questioning more and be a whole lot angrier about inflation. So I want to pick through that to end this conversation. So first, where do you guys see inflation going the next couple of months, and why should people be more pissed off? The average person who doesn't understand inflation, why should they be more pissed off about this inflation? Let's throw it to Dr. Jeff Ross, and then James maybe finish it off.
Yeah, sounds good. So first of all, I don't know the answer, right? I don't know what tomorrow is going to bring. What I'm more concerned about is what are the big trends. And from what I gather, the big trends, inflation, the CPI number spiked and peaked in, I believe, June of 2022, and it's been disinflating since that point. I continue to think, regardless of what the February 14th number is for January, that we're still going to see a general disinflationary trend throughout the year. I think Powell, by the way, has alluded to that very clearly. He said in the second half of 2023, we're going to see more pronounced disinflation because of the OER, right, the owner's equivalent rent. That should be kind of rolling into it at that point, and it will have rolled over. And so I think a lot of people calling for just straight up sticky inflation, I think will be surprised, and I think it will come down a bit more. I will say that I don't personally care because I just care what are asset classes doing, where are they moving, and how do I, make money for my investors and protect the downside risks. The other thing to consider is like what just happened with the unemployment numbers, right? They changed how they calculated the number, and everybody was up in arms, right? It was a 9 sigma event, I believe, is what I heard. Way higher, 500,000 people instead of 150,000 or whatever. They're changing the way they calculate CPI too. And so this is the first time we're going to see that number. So I would say nobody really knows, other than the people who are calculating the number, what the effect will be. The whisper number that I hear, that it's creeping higher and higher. People are thinking it's going to be higher, and I think that's why markets are responding unfavorably. Interest rates have been going up, volatility has been rising, the dollar has been creeping up, risk assets have pulled back. But I like that setup. If I'm long term, and if I'm bullish, if I'm long risk assets, I like it when it's weak going into an announcement, because I think then the surprise, if it is higher than expected, the markets have already kind of priced that in. If it's lower than expected and it kind of surprises to the downside, I think that could cause risk assets to pop in the near term. So that's my general takeaway. I'd love to hear what James has to say.
Yeah, no, I think that's a good point. We talked, in my newsletter, we talked about the adjustment to the CPI, and I think it's going to be positive for the Fed, meaning it's going to push inflation lower because of the adjustment of how they do the periods. You can read all about that in the newsletter. But like Jeff said, that look, the Fed needs inflation to come down, right? So the market is going to react around that tomorrow. Now, the question is how much they need to come down before they let up and say that, all right, we're still at either a neutral or above neutral rate, meaning that if you're above neutral rate, the policy is tight enough that it's causing inflation to go lower because you're taking liquidity out of the market, right? So if the Fed comes out and has positions himself at all that they feel like, okay, we're at a point now where we're seeing inflation come down, so we're going to pause here and wait for a minute, and we don't, and it looks like they're going to pull off the break for March and not tighten again. That would be explosive for risk assets, but I don't think they're going to do that. I'm not going to sit here and play the Fed. It's obvious we're still above 6% inflation. It's nowhere near the 2.5% that they claim is the target. So they've got to keep it coming. They've got to keep on the brake. They've got to keep tightening up just at least one more time. I think they're going to tighten once or maybe twice, depending on the data that comes in. And but the CPI number tomorrow, I think it's kind of non-consequential, really, unless it's a huge surprise lower, meaning it's in the fives. I just don't see it being that impactful for the long term. I think that the Fed is on the path to raise another 0.25% next month, and that's where we're at. And so I'm not really keyed in on that in particular. Okay. Why should people? I mean, I'm going to obviously watch it, and we may have to trade around it, but why should people be angry? Because inflation is just an extra tax. And the reality is the way that CPI is calculated, it's not calculated in a way that really impacts people, right? Their everyday lives. You go to you go to the supermarket and you're paying hundreds and hundreds of dollars for groceries that you may have paid $100 for last year or the year before. And suddenly everything is so much more expensive. Everything is so much more expensive. And you're thinking, how are they saying inflation is only 6 or 7%? It feels like 15 to 20% to me. Well, because they changed the way they calculate it. They changed it a while ago. And instead of using the basket of goods, they use a cost of kind of a cost of living index. And so it's a completely different way to look at it. And so they can manipulate that and make inflation look better. Why do they do that? Well, If you want the real reason, it's because we need structural inflation, long-term negative real rates, meaning you need goods to inflate faster than interest rates are rising, or at a rate that's higher than your interest rates, right? Your rates of return on your bonds. So why do they need that? It's in particular the Treasury. Well, they need GDP nominally to expand, and so by having higher prices, companies make more dollars, and then they get taxed more dollars, and then they're able to take those taxes that the Treasury collects and pay down the debt that they had with cheaper dollars, the old debt with cheaper dollars. So that's in effect inflating away the debt, and they have to do this for a very long time. And I think that they know that inflation is going to be somewhere between the 4, 5, 6% range. In reality, 4, 5, 6, 7% range, but they're going to keep gaslighting people into saying, "Oh no, it's only 2, 3, 4%." And what are people going to do? Well, the Fed says it's only 4%. I guess I'm buying the wrong things. Well, and they're going to just continue to inflate away. That's just structurally what's going to happen. That has to.
Yeah.
So that's my take on it, and it should piss people off because that's the reality.
It's financial repression, right? That's kind of what you're describing there. Yeah. Yeah. I just think about like a regular teacher or something wondering why she's going to the grocery store, and I would love people get the message out with inflation that it's a policy choice, right? It's not this like natural phenomenon. But I could keep talking to you guys for hours on this stuff, but you guys have been generous with your time, so probably a good time to stop here. Just where can people find you? On Twitter, wherever. Dr. Jeff, where do you want to send people?
Sure. So I'm most active on Twitter. My handle is at Vailshire Cap, and like we kind of talked about a little bit, I do run a hedge fund and also separately manage accounts, a registered investment advisory. So if you want to find out more for that, you can actually just shoot me an email, info@vailshire.com. Thanks for having me on today, Sam.
Yeah, and you absolutely should. Jeff is awesome. If you're not following him, you should. And as for me, I'm also on Twitter. I'm at James Lavish on Twitter, and you can find the information, my newsletter, in my handle on my about page on Twitter. And if you want more information on the fund and you're an accredited investor, you can go to just www.bitcoinopportunity.fund. And you can, request information. We'll get that to you. So, but it's been great. Thank you for having us on, Sam. I always love talking to Jeff. He's a super smart guy. I mean, you have to be a doctor, right, Jeff? So, and it's always good to hear his views, because he's got some takes that are very that are clearly. He's a critical thinker, and I appreciate that. So it's awesome. So good to be with you, Jeff.
I thought you were going to say that are clearly wrong. I was just waiting for it. Thanks, brother. Hey, let me do two shills. First of all, Sam, thanks, man. You're like one of my favorite new people at Swan. I think James and I both love what Swan is doing across the board. We love what you're doing and your macro thinking, and you're a great host as well. So thanks for that. Man. And then James, by the way, so I went back and got my MBA in finance several years ago. On the side, and I will tell you that James's newsletter, The Informationist, is better, and I'm not kidding, better than any financial education you will get from a traditional school. You can go back and get your MBA if you want to, but if you want to actually learn the important concepts in finance, the way actual fund managers think about things, the way that actual asset classes move and why they move and why finance works the way it does, you have to read James's newsletter. It's just fantastic, and he has such a great way of taking really complicated topics and boiling them down into simple, easy to understand and applicable lessons. So couldn't recommend it more highly, James. You do a great work with that, and I'm really impressed with your work.
Well, thank you, buddy. I appreciate that. No, I really appreciate that. That's what I want to do, is simplify it for people, for everybody. So thank you. I appreciate that.
That's The Informationist, if you're listening, and I couldn't agree more. I mean, he seriously does an amazing job explaining complex topics, which is really important for, financial literacy and helping drive that forward. So, James, keep doing that great work, man. Absolutely. And thanks for coming on, guys. sharing your insights. Really appreciate it. You guys are both important voices for Bitcoin and just helping educate people. So appreciate you guys coming on, and have a great day.
Thanks, Sam.
And you. Thank you, Sam. See you, Jeff.
See you, James.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.